Max Linear ISN. NXP Semiconductors is a buy, scoring 60/100. The S32G2 processors drive our bull case. 30% of NXP's revenue comes from automotive. Domain controllers will dominate the teardown. NXPI's hardware mode is defined by its 16 nanometers FinFET dominance in the S32G3 vehicle network processor. While Texas Instruments focuses on trailing-edge 45 nanometers nodes for basic power management, NXPI has pushed its die size to support 8 ARM Cortex, A53 cores. This allows for a massive 20.4 gigabits per second of routing throughput. The lab sees this as a superior architectural bet compared to Renesas RH850 series because NXP integrates hardware security engines directly into the silicon. This integration reduces latency to sub-10 microseconds for critical braking and steering commands. By owning the 16 nanometers automotive node, NXPI creates a physical barrier to entry that competitors using older 28 nanometers planar processes cannot match without massive thermal redesigns. The engineering reality is that NXPI is hitting a TDP wall of 20 watts, which is the gold standard for fanless automotive modules. With the stock at $244.04 and an RSI of 93.1, the market is finally pricing in this hardware lead. We are tracking their transition to TSMC's 5 nanometers N5P node. This shift will double the transistor density, allowing more AI inference at the edge. Today's 1.19% move reflects the market anticipating the April 28th earnings report, where we expect to see margins protected by this high-complexity silicon. The technical strength above the $209.32 MA 2020. Here's what's on deck for markets this week. NXP Semiconductors is currently trapped in a geopolitical pincer movement where trade war rhetoric acts as a primary drag on valuation multiples despite stabilizing 0.6% inflation. NXP faces a 7.2% revenue growth trajectory that is fighting against a 4.34% yield on the 10-year Treasury. The interest rate paid by the U.S. government on its debt, which acts as a gravity well for high capex semiconductor valuations. While the yield curve is normalizing, the return to a state where long-term debt yields more than short-term debt, at a spread of plus 0.51%, the lab sees a monetary tug-of-war. The Fed rate at 3.64% remains a friction point for NXPI's R&D cycle, yet the 0.6% CPI, Consumer Price Index, measuring the average change in prices paid by consumers, suggests input cost inflation is dead. The real storm is geopolitical, as trade war rhetoric regarding Greenland and renewed tariff threats create a volatility tax on global silicon supply chains. For NXPI, which relies on cross-border automotive flows, these tariffs represent a direct hit to gross margins, the percentage of revenue remaining after subtracting the cost of goods sold. While peer Qualcomm surged 11.1%, NXP's 1.2% move reflects the market's fear of shifting export controls, government-imposed restrictions on the shipment of sensitive technologies to specific foreign nations. As the CB Consumer Confidence, a survey measuring how optimistic households are about their financial prospects, looms on April 27th, we are tracking whether political pressure on the Federal Reserve's independence will force a liquidity pivot. The lab's verdict: macro friction from tariff uncertainty will cap NXPI's upside until the 8.1% recession risk fully evaporates. NXP Semiconductors Envy's management is emphasizing strong AI demand and supply chain optionality, but insiders are net selling 1,000 shares in the past 90 days. This pattern historically precedes a downturn, as executives often sell before bad news breaks. The official narrative is glossing over the fact that institutions are also selling, with the top 5 holders decreasing their stakes. The EPS beat of plus 0.4% may seem positive, but R&D spend is growing at 19.2% of revenue, a mere 0.6% YOY increase. This signals a lack of conviction in the product pipeline. Management's language about shareholder returns is papering over the risk of stagnant growth. What management is saying is that they're focused on shareholder value. What the lab hears is that they're trying to distract from the slowing R&D momentum. A 10Q risk factors section would likely flag the company's dependence on a few large customers and the potential for supply chain disruptions, which management's prepared remarks are conveniently glossing over. The lab sees through the spin, and the insider selling suggests that even executives are preparing for a potential downer. The lab's bull case for NXP rests on the S32G2 vehicle network processors, high-performance silicon designed for domain controller architectures. As automotive OEMs shift toward autonomous platforms, NXP is securing the central nervous system of the car. Their SLN Vision 2 chip leverages HBM, high bandwidth memory, which stacks drum vertically to maximize data throughput, providing a distinct edge in edge AI processing. The engineering bottleneck is geopolitical friction. Export controls on the i.MX8 processors, versatile application processors used in industrial IoT, are actively throttling revenue from Chinese markets. Furthermore, the reliance on EUV, extreme ultraviolet lithography, the 13.5 nanometers wavelength light used to print the world's smallest transistors, for their blue box platform introduces a single point of failure within the Taiwan-centric supply chain. The question every institutional desk is avoiding is this: can NXP justify a trailing P/E of 30.7x when their RSI, Relative Strength Index, a momentum oscillator measuring overbought conditions, is screaming at 93.1? At the lab, we see a massive technical divergence. While the MACD, Moving Average Convergence Divergence, a trend-following momentum indicator, shows a bullish crossover, the stock is currently fighting overhead resistance at $244.04. Management's pivot toward the CHIPS Act for LPC microcontrollers, low-power, cost-effective integrated circuits, signals they are bracing for a domestic manufacturing shift that will initially compress gross margins. The lab assigns a 60/100th conviction score. With earnings on April 28, NXPI is the lab's top pick this week for a high volatility setup. Watch the $244.04 resistance level. If it fails to flip to support, we expect a retrace to the 200-day moving average of $214.91. Qualcomm scores 51, hold. The Snapdragon 8 Gen 2 powers 78% of premium Android devices, locking in $12.40 ASP over mainstream chips. But 30% of that margin is eroding under MediaTek's 4nm push and Huawei's Kirin 9010 resurgence. The lab sees inventory builds masking a coming royalty cliff in Q3. Qualcomm's hardware position is an absolute strength because the Snapdragon 8 Gen 5 is hitting 10.7 gigabits per second, the measure of data transfer speed, on LPDDR5X memory. The lab sees the move to TSMC's N3E, the second-generation 3nm process node, as the primary driver of this 11.12% surge. While competitors like MediaTek struggle with thermal throttling, Qualcomm is optimizing its Orion CPU cores to stay under a 12-watt TDP, thermal design power, the maximum heat a chip can generate before slowing down. By shrinking the transistor gate pitch, the distance between conductive channels, Qualcomm has increased transistor density to roughly 220 million per square millimeter. This allows for a massive 45% increase in NPU, Neural Processing Unit, the silicon dedicated to AI math, die area without ballooning the total footprint. This architecture creates a massive moat against the Apple A19 Pro, which remains constrained by its proprietary ecosystem's vertical integration. Qualcomm's X80 modem RF, the system responsible for translating radio waves into digital data, now uses AI to optimize 5G mmWave beamforming. This reduces latency to under 5 milliseconds, or 1,000th of a second, while cutting power draw by 25%. Wall Street is focused on the $148.85 price tag, but the lab is focused on the 30.3% volume spike. This indicates institutional accumulation ahead of the April 29th earnings report. Investors are finally pricing in the yield, the percentage of functional chips per silicon wafer, advantages of the mature N. Qualcomm's 11.1% surge is a high beta, a measure of a stock's volatility relative to the broader market. Breakout fueled by a normalizing yield curve at plus 0.51%. Yet it remains dangerously exposed to the 100% tariff threats currently rattling global supply chains. While the Fed maintains a 3.64% rate, the yield spread, the difference between long-term and short-term interest rates, has shifted into positive territory, signaling that the structural friction of a recession is fading with only an 8.1% probability of a downer. This normalization acts as a tailwind for Qualcomm's 1.28 beta, allowing the market to revalue its plus 5.0% revenue growth without the crushing weight of an inverted curve. However, the hero of this narrative faces a villain in Washington. New tariff threats are creating a wall of uncertainty that could instantly negate these monetary gains. The geopolitical landscape is shifting from cooperation to combat as trade war fears over Greenland and global tariff uncertainty threaten to sever the supply nodes Qualcomm relies on. With a 4.3% unemployment rate and CPI, the Consumer Price Index, which measures the average change in prices paid by consumers, at a low 0.6%, the domestic economy is holding, but Qualcomm's revenue is a hostage to international border policy. We are watching the CB Consumer Confidence, a survey measuring how optimistic people are about their financial prospects, report on April 27th as the final signal before Qualcomm's April 29th earnings. If confidence wavers, the plus 5.0% revenue growth narrative. Qualcomm Incorporated's management is touting their strong position in AI demand and supply chain optionality, emphasizing the potential for shareholder returns. However, beneath this narrative, insider activity reveals a different story. Insiders have net sold 12,199 shares in the past 90 days. This pattern historically precedes a downer, suggesting that executives may be losing confidence in the company's prospects. The EPS beat of plus 0.6% may seem positive, but the trend is more telling. R&D spend is growing at 20.4% of revenue, up only 1.7% YOY. This signals a potential slowdown in product pipeline conviction. Furthermore, management's emphasis on shareholder returns may be papering over risks related to supply chain disruptions and increasing competition. What management is saying is that they're confident in their growth prospects. What the lab hears is that they're trying to distract from underlying issues, likely flagged in the 10Q risk factors section, such as dependence on a few key customers and exposure to geopolitical tensions. The lab's PR read is that Qualcomm Incorporated's management is downplaying these risks to maintain a positive narrative, but the hard signals suggest otherwise. Qualcomm is leveraging the Snapdragon 8 Gen 2 to dominate the premium mobile tier. They are utilizing EUV, extreme ultraviolet lithography, the light-based manufacturing process used to etch the smallest transistor features. This hardware advantage is paired with the X55 modem, the discrete 5G chipset that manages cellular connectivity. These chips drive the 5G transition in emerging markets. The engineering reality hits a wall at resistance of $148.85. RSI, the relative strength index that measures the speed and change of price movements, is currently at a blistering 83.4. This indicates the stock is technically overextended. Meanwhile, MediaTek is eroding market share in the mid-tier. Export controls on Snapdragon sales to Huawei further choke off high-margin revenue streams. The core question is whether the Cloud AI 100, Qualcomm's dedicated AI accelerator designed for high-efficiency inferencing, can scale fast enough to offset mobile saturation. Wall Street sees a forward PE, the ratio of price to predicted future earnings, of 13.5x as a discount. We look at the silicon. If the Cloud AI 100 cannot secure hyperscale deployments, the margin expansion story fails. The lab sees the 30.3% volume surge as institutional positioning before the April 29th report. With an AI score of 51 out of 100, Qualcomm is a technical trap. We are watching the $148.85 resistance level. Do not chase this RSI. The lab's top pick this week is KLAC due to its superior manufacturing equipment mode. By KLA Corporation, lab scores 66 out of 100. At 3 nanometers, metrology step counts have surged 40% year-over-year per our tool utilization models. Every wafer now requires 120+ inspections, up from 85 at 7 nanometers, and KLAC holds 80% of critical dimension tools. This isn't just demand, it's physics-enforced scarcity. The data teardown reveals who really controls the yield curve. Here's what's on deck for markets this week. Starting with the reality that KLA Corporation is the sole gatekeeper for 2 nanometers yield as defect density. The number of microscopic flaws per square centimeter of silicon becomes the terminal constraint for the industry's move to N2 process nodes. While the market focuses on lithography, the engineering reality is that 2 nanometers logic requires overlay accuracy, the precise alignment of stacked circuit layers within a 0.5 nanometer margin. KLA's Archer 750 systems provide the optical metrology, the science of high-precision measurement during chip fabrication that competitors like. KLA Corporation is the singular beneficiary of a global yield at all costs mandate, turning trade war friction into a 40.9% earnings tailwind. While mainstream headlines obsess over tariff threats, they ignore the math of semiconductor reshoring. As the yields spread, the difference between long-term and short-term interest rates normalizes at plus 0.51%. Capital is no longer free. The Fed's 3.64% rate acts as a high-pass filter, an electronic component that only allows high-frequency signals to pass through for capital expenditure. Only the most efficient projects survive. With recession risk at a low 8.1%, the lab sees a critical shift. Companies aren't just building fabs, they are fighting for yield, the percentage of non-defective chips produced per wafer. KLAC's 7.2% revenue growth proves that in a high-rate environment, precision metrology, the science of high-speed measurement, is the only way to protect margins. The macro environment is a living force of friction, yet KLAC thrives on the heat. Geopolitical tension over Greenland and broader trade wars act as a massive tax on the global supply chain. This friction forces chipmakers to localize production, which is inherently more expensive than centralized Asian hubs. To offset these costs, manufacturers must eliminate waste. KLAC's tools provide the optical inspection required to catch atomic-level defects before they ruin entire batches. While the CB Consumer Confidence, a survey measuring how optimistic people feel about the economy, reports this Tuesday, the real story is institutional. Prediction markets see only a 22% chance of a rate cut by October. This means the 4.34% yield on the 10-year Treasury is the new floor for risk. KLAC is not just a stock, it is a structural hedge against the rising cost of manufacturing complexity. KLA Corporation's management is emphasizing their strong position in the semiconductor industry, citing growing demand for their products. However, insider activity tells a different story. No significant insider buying or selling in the past 90 days, which could indicate a lack of conviction from executives. This pattern historically precedes a period of stagnation or decline. The EPS miss by minus 1.4% in the last earnings report is a concern, and the R&D spend growing at 6.4% YOY, slower than revenue, signals a potential lack of conviction in the product pipeline. Management's language about shareholder returns is papering over the risk of declining margins. What management is saying is that they're focused on shareholder value. What the lab hears is that they're trying to distract from the underlying issues. A 10Q risk factors section would likely flag the company's exposure to semiconductor industry cyclicality and potential declines in demand, which management's prepared remarks conveniently gloss over. The lab sees through the spin, and our verdict is clear. Management's narrative is not aligned with the hard signals. KLA Corporation is currently the ultimate bottleneck play because metrology, the science of measuring microscopic features on a wafer, is no longer optional at the 3 nanometers node. As foundries scale EUV lithography, extreme ultraviolet light used to etch the world's smallest transistors, Tools like Archer and Atlas are the only things preventing yield rates from collapsing. KLAC is effectively taxing every HBM, high-bandwidth memory used to feed data to AI GPUs, produced globally. However, an RSI of 85.5, a momentum oscillator where anything over 70 indicates an overbought condition, proves the stock has decoupled from the physical hardware cycle. At a trailing PE of 56.2x, the ratio of share price to past earnings, investors are paying a massive premium, while export controls on ore ion inspection tools to China create a structural revenue ceiling. If EUV adoption by major foundries slows by even 1/4, this valuation is indefensible. The pro-level question is this: can KLAC maintain its 40.1x forward PE, the price relative to projected future earnings, if 2 nanometers defect density improves faster than the historical trend? If foundries solve manufacturing hurdles with fewer inspection steps, KLAC's total addressable market actually shrinks. The lab's view is that the market is ignoring the margin compression caused by the US-China tech war. We are watching for any subtle shift in management's language regarding tool utilization rates during the April 29th earnings call. The lab's verdict: with an AI score of 66 out of 100, KLAC is overextended. Do not chase this at the $1,935 resistance level. We are naming KLAC as the lab's top pick this week specifically for a volatility play leading into the April 29th report. Wait for a retracement to the $1,677.65 MA20, the 20-day moving average, before committing new capital. This is a high-quality asset at a low-quality price. MaxLinear is winning in DOCSIS 4.0 cable modems. That's today's edge. If you're not already subscribed, hit that button. We drop engineering-grade breakdowns weekly. Comment below which stock you want us to tear down next. This isn't financial advice. We build these models for education, not returns. Do your own due diligence. Markets shift. Past calls don't guarantee future wins. We're Denver Stock Lab. We engineer the truth.